Something very interesting has been happening in tri-party repo. And that is US usage of US Treasury collateral has been essentially flat over the last year. There's been ebbs and flows along the way, but US Treasury collateral use has been flat. The amount of repo funds that are borrowed in using US Treasury collateral has been flat. At the same time, though, MBS collateral has increased a substantial amount. Let's call it that. In June of 2022, and these are snapshots that the Federal Reserve Bank of New York puts together on, I believe, the seventh day of every month. They tell Bank of New York Mellon, tell us what's going on through your tri-party repo platform on the seventh day of every month. So on the seventh business day of June 2022, Bank of New York Mellon said there was 3.1 trillion in U.S. Treasury collateral outstanding. So that's repo using U.S. Treasuries, and that's bills, bonds, notes, and everything else in between. On the same day, June of 2022, there was only 540 billion in agency MBS. You fast forward to December 2022, still 3.1 trillion in Treasury, but now 651 billion in MBS. April of 2023, as we're getting into the major crisis, the collateral squeeze, believe it or not, Treasury repo volumes went up to 3.5 trillion in April of 2023, while at the same time MBS tri-party repo went up to 744 billion. That's the scramble for cash and funding during an emergency period, really. Pretty much the same numbers in May of 2023, 3.5 trillion of U.S. Treasury collateral, 786 billion of MBS collateral. Then we get into the collateral deluge, the Treasury bill deluge. Conditions start to calm down starting in June and July. What seemed like a benign collateral environment with so much Treasury bills being issued. We see repo volumes and treasuries, those declined to 3.1 trillion. We see repo volumes using agency MBS actually declined to 751 billion. But over the last couple months, volumes of repo using US Treasury collateral, they've continued to decline, while volumes using agency MBS collateral, those have increased sharply yet again. It's 2.8 trillion as of the seventh business day in September versus 818 billion in agency MBS. So we went from 540 billion in June of 2022 to 818 billion in September 2023. At the same time, the volume of repo using Treasury collateral was about the same and actually moving lower in September. That's an interesting point, especially as it's compounded by the statistics in GCF repo. GCF repo is bilateral repo, and this is only what's tracked by DTCC's platform or FICC. But essentially, it's what shows up that gets reported by the various dealer banks in GCF repo. So there's a lot more of GCF repo out there in the offshore Eurodollar world. We're only seeing a very small snapshot of it in these statistics, but what it tells us goes further than tri-party repo in terms of this growing preference and this growing use for agency MBS, seemingly at the expense of U.S. Treasury collateral. Now, these statistics are aggregated nominal values that got cleared through FICC. So it's not a single day. It's the aggregate notional for an entire month, or in this case, we're going to talk about the quarterly statistics for an entire quarter. So back in the third quarter of 2021, GCF repo using U.S. Treasury collateral was about 3.4 trillion. Again, that's just a partial snapshot of the overall marketplace. But 3.4 trillion using treasuries and 1.4 trillion agency MBS. Fast forward a year to the third quarter of 2022. Remember all the fireworks and collateral outside the United States, the gilts, all that stuff, German bonds. Suddenly in GCF repo, there was only 1.6 trillion used on treasuries, but suddenly 2 trillion in agency MBS. And we get to the first quarter of 2023, which touches March. There was a rebound in Treasury collateral to 2.1 trillion in the first quarter, but agency MBS continued to rise to 3.1 trillion. And then we get the third quarter statistics, which show, again, 1.3 trillion in U.S. Treasury collateral for the third quarter versus 3.5 trillion for agency MBS. So MBS picked up to the highest level in forever, while U.S. Treasury collateral in GCF continues to fall. In fact, you look at these statistics From the third quarter of 2021 to the third quarter of 2023, over those 2 years, they've completely flip-flopped. Treasury usage was 3.4 trillion versus only 1.4 trillion for MBS. Now it's 3.5 trillion for MBS and only 1.3 trillion for Treasuries. That is the puzzle that we need to work out here, because GCF repo is an important, enormously important part of this global collateral fabric. And it's backed up, what we're seeing in GCF repo is backed up by what we're also seeing in tri-party, this increasing usage of MBS collateral. And that begs the question, why? What is really happening here? And again, as we keep saying here, it's incredibly important because as lower quality collateral gets thrown out of the system, it leads people to go into the higher quality collateral. But what is higher quality collateral in the system today? It seems like it's different than what it was just a couple years ago. And it's been transforming and moving over the last several years. Does that mean that the repo market is rejecting treasuries in favor of agency MBS? I mean, that's possible, but very, very unlikely. I don't believe that's what we're seeing here. Instead, I think what we're seeing, and this is my answer, but it's still, not sure it's the best one. I think the answer here is money market funds. Because over the last couple of years, what have money market funds been doing? Well, they've been growing as cash has migrated away from regional banks and some other banks into money market funds. And as those money market funds have all this cash available, what are they doing with it? Well, they're buying a lot of treasury bills. So as they're buying treasury bills, it almost becomes like a QE in the sense that QE removes collateral from the system. Money market funds are taking treasury bills from the system and locking them up on their portfolios, leaving less maybe for the marketplace. Because we can't explain this MBS, and it's not interest rates, it's not price sensitivity, because price sensitivity, there's the same price sensitivity in MBS as there is in treasury securities, and MBS has a hell of a lot more because they have longer duration. And repo rates in MBS versus US Treasury, those have been pretty much lockstep the entire way. There's something else that's causing this transformation in GCF as well as tri-party repo that is favoring MBS collateral. Despite the fact that Treasury bills have been issued, they've been deluged over the last couple of months, really four months now, maybe they're not as available as we assume. Maybe money market funds have been taking too many of those bills, leaving fewer and fewer available to circulate. Now, there's been more than enough to circulate because it's not just been money market funds buying bills, but as that deluge starts to trickle back a little bit, does that leave us in a situation where money market funds have too many bills and we don't actually have as much supply of bills that we thought? And in the repo market, maybe repo market participants are moving to MBS collateral as an alternative to the treasury bills that they can't get a hold of. But even though Treasury has supplied a lot more bills, if too many of those bills have gone into money market funds, maybe there's a vulnerability over and above than what we would otherwise expect given the supply characteristics.